Imagine waking up one morning to the sound of your cell phone buzzing off the hook, with multiple text messages from multiple friends linking to various different articles. And every article points to the exact same thing. The market's crashed. You open up your stock market portfolio or your cryptocurrency wallet or a link to the price of gold, only to find that the value of every asset you own has gone down significantly. 25, 50, maybe even as much as 80%. It's the beginning of the next big financial crisis. And ironically, this has all happened before. And the exact same thing that caused every previous financial crisis before it is exactly the same thing as what is leading to the problem you face right now. And the irony is these financial crises don't come out of nowhere. There's always a spark. It's always the exact same thing that leads to the problem that is inevitable. And in today's video, we're going to talk about that one thing that has started every single financial crisis in history and how you can spot the warning signs. And I'm telling you right now that there is in fact a bubble brewing. The only problem is we don't know which sector or which investment it's brewing in, but it is without a doubt brewing. And therefore it's important for you to know the warning signs and know how to protect yourself. But before we get into it, my name's Nolan Matthias, and if you want the truth, the real truth about personal finance, this is the place for you. And if furthermore, you believe that there is opportunity in crisis, then this is definitely the place for you. So go ahead and hit that subscribe button and hit that like button so more people like you can see this video. Okay, so let's get into it. From modern housing bubbles to the 17th century tulip mania, financial crises are almost always caused by exactly the same thing. And the root causes reveal important lessons that we can learn from, and lessons that we as humans, for some reason, tend to repeat. And for some reason, as humans, we continue to make the same mistakes that previous generations have made before us. But if you pay attention and you look at what has really caused every financial crisis in the past, it becomes pretty easy to spot the potential problems and subsequently to avoid them. So let's start by thinking back to 2008. Homes were lost, savings evaporated, investment values declined by as much as 50%, and jobs disappeared overnight. The root cause was subprime mortgages. But the warning signs existed before subprime mortgages were even known to actually be an issue. But these warning signs were ignored. And if you go back even further and you look at the Great Depression, it was the leveraged buying of stocks that led to one of the single biggest crises in world history. But the signs prior to the Great Depression were the same as those prior to the financial crisis. There was one obvious cause. Then look at the dot-com bubble in 1999 and early 2000s. Yes, it was primarily the fact that many of these companies had zero assets and zero real revenues that led to the entire thing coming down. But again, it was the exact same problem as the Great Depression and the housing crisis. And by the way, the same problem that was faced in the 1600s when it came to the tulip mania. And in all of these cases, the financial crises are like avalanches. They start small and they grow until there's a massive collapse. Whether it was the 1920s, the early 2000s, 2008, or the 1600s, all of these financial crises were fueled by one thing and one thing only. And if you compare those times to today, we see many similarities. There's global chaos, there's inflation, there's the crypto market and the run-up in gold prices. And in many places, like in the stock market, the crypto market, and the gold market, there seems to be unsustainable growth that is fueled by speculation and greed. And while those markets have not collapsed yet, the same storm that brewed before the 2008 financial crisis, the dot-com bubble bust, the Great Depression, and tulip mania is brewing once again. Yet for some reason, we're too blind to see that it's actually happening. I mean, it's like we literally have these blinders on. All the signs are there. We shouldn't be buying all the gold and all the crypto and all the stocks, but we continue to do it because of the belief that they can only go up in value. In the same way that in 2008, we believed that housing prices could only go up, and during the 1990s, we believed that pretty much everything tech-related could only go up in value, and during the Great Depression, we believed that stocks could only go up in value. We're setting ourselves up for the exact same failures that were faced in all of those major financial crises. Because the one thing that caused every single financial crisis in history was the belief that assets could only go up in value. And that belief led people to do crazy things, like in the 1920s, borrow money to buy stocks. And in the early 2000s, borrow money to buy tech stocks. And in 2008, borrow way more money than people could afford in order to buy way more property that they could afford, which is what led to the financial crisis. And this was even in the face of realizing that in 2000, companies were overvalued. They had no revenue. Warren Buffett stood there and screamed, "I'm not going to invest in these companies because they have no value, they have no revenue, and I can't see any reason to invest in them. They're too risky." And in 2008, we saw the same thing with risky mortgages and housing prices. And we can even go back further to tulip mania in the 1600s, where people borrowed money, where futures were literally invented so that people could buy more tulips than what they could actually afford, driving speculation and higher prices on something that, think about it, is literally just a plant that could be planted in the ground and grown by pretty much anybody. And all of these crises showcase that humans, when faced with the opportunity to buy something that can only go up in value, are willing to jump on board without any thought whatsoever. And in today's day and age, we're seeing many people do the exact same thing with stocks, gold, and cryptocurrency. The problem today, though, is that we don't know which of these markets is going to be the one that crashes. And what's even more disturbing is that the people who believe in stocks and the people who believe in gold and the people who believe in cryptocurrency all believe that the one thing that they are invested in is the one that is perfectly safe. It's the one that's crash-proof and recession-proof, even though something like cryptocurrency really doesn't have any foundation for the values that it's trading at. And when you think about the fact that pretty much every country in the world no longer uses the gold standard, well, gold doesn't have any sort of foundation for the value it's being traded at as well. And this, at some point in the future, will be, in hindsight, so painfully obvious to so many people. And when one of these markets does in fact crash, for the people that have all of their money in just the one thing that crashes, it is going to be painful. But here's the thing. You don't have to have your entire net worth wiped out by one crashing asset if you're smart. And the way to prevent seeing your net worth shoot past zero on the way down is to make sure that you're always diversified. Never put all of your money into one single asset, believing that it can only go up in value. Instead, you need to be choosing multiple assets. You need to be diversifying your portfolio, and you need to be diversifying it for risk. Because if you ask people in 2006 if housing could crash, they'd tell you no. And if you ask people in 1998 if there was any chance that a company that had .com in its name could go down in value, they'd say no. The future's in technology. And if you ask anybody in the early 1920s if the stock market could crash and wipe out pretty much all of the net worth of the entire world pretty much overnight, they would have told you absolutely not. So when somebody tells you that gold can only go up in value and cryptocurrency can only go up in value and stocks can only go up in value, the best thing you can do is head for the door as fast as possible. But that doesn't mean getting out of the asset completely. What it means is making sure that you aren't overexposed to any single asset. And the minute that you start to see rapid price increases and risky behavior, people borrowing money to buy something, people borrowing money off of credit cards to buy cryptocurrency, that's usually a sign that the market is saturated. And it's this spark that causes everybody to want to be involved that eventually leads to the collapse. Where you find speculation, bad debt, and blind optimism, you will almost always find a bubble that is on its way to an eventual pop. And when it comes to investing, the number one rule of investing is don't lose money. It's not about how much money you can make on the way up. It's about making sure that you don't lose it all on the way down. And the best way to avoid losing all of that money on the way down is to avoid speculative excess. And right now, there's many markets where the warning alarms are ringing. And those same warning signs are always there. If you know where to look and you think about it rationally, not only can you avoid the next major financial crisis, but you can also profit from it. Because history doesn't repeat, but it always rhymes. And if you stay informed, you stay prepared, and you stay ahead, you can get ahead. And by the way, if you want to know what always happens before a financial crisis, make sure you check out this video right here.